Hey guys, thanks for tuning in. My name is Abir Khan, and in this video, we will talk about the growth stocks. Investing in growth stocks can be a great way to increase your wealth over the long period of time. But this strategy also comes with greater risks than investing in more stable blue chip companies. So let's take a look at what growth stocks are and how you can smartly invest in them. So to begin with, you need to understand what is a growth stock. A growth stock is a stock in a company that is performing high above the average industry returns. The company is growing rapidly and its cash flow, revenue, and earnings are expected to outpace the competition. Usually the company has some sort of lock on the market, whether that be a radical innovation or a strong patent on an in-demand product. So say for example, Amazon has a great hold on cloud technology, so that can be considered as a growth stock. Anyway, moving on, we need to remember that not all growing companies qualify as growth stocks. While there is no one single formula to determine what qualifies as a growth stock, there are general terms. Growth stocks usually have more than 15% growth annually. They show strong stock performance historically and have strong profit margins. But remember, there are some drawbacks of growth stocks as well. Growth stock companies generally do not pay dividends because the companies are primarily reinvesting their earnings into new or better products. They are trying to maintain a clear advantage in the market, so they basically take their money and use it to fuel their growth. So this means that investors don't make money from dividend payments, but rather only from the sale of the stock. Timing when that sale should happen is extremely a tricky process, and 95% of us fail to do so. So selling stocks too early and you'll lose money on future growth. Sell it too late and you lose money because of the declining profits. So don't forget that it is a risky gameplay here. So how does a growth stock differ from a value stock or an index fund? The most direct comparison to growth stock can be made with value stocks. Value stocks are stocks that trade at a lower value than their competitors and they pay dividends. The idea behind being a value stock investor is to purchase a valuable stock while its shares are priced low, so that as the stock grows in the value, your dividends and overall value of the stock grows. And this on the right hand side, if you see here, are mostly value stocks. So Verizon, T-Mobile, AbbVie, Occidental, Shell, and most of these stocks you see here are the value stocks. Growth stocks differ from index funds in a few key ways as well. First, growth stock purchases are individual stocks purchases. So when you buy an index fund, you are basically buying into every company in that index, which means that your purchasing power has been automatically diversified, which is the case here if you look at the Vanguard High Dividend Yield ETF that I have here. But with growth stocks, you aren't buying an index, you are buying only one single company. If that company does well, you'll reap all the benefits that company will receive. But if that company doesn't do well, you can lose more than if you own an index fund. So index funds may be a combination of growth and value stocks, appeals to people who just start investing. So you don't have much knowledge, then you should go with index funds. Okay, so now the most important question, where can you find the growth stocks? So growth stocks can be a part of index or mutual funds, which you can buy as an initial investor. But beyond that, you'll have to identify which stocks are growth stocks with financial magazines, or do some research online, and you will be able to understand and differentiate between growth stocks and the value stocks. But before you make any purchase of growth stocks, you'll have to determine what qualifies as a growth stock to you. Keep the criteria in mind as you start your research. That is, strong market performance in the last few years needs to be there. Also, the company is showing the continued or accelerated production and output, as well as a clear identity in its respective arena. From there, you will begin to build a strong list of growth stocks that you might be interested in buying. Make sure to spend good amount of time in your research, listen to the experts, and make sure to purchase the stock at the good value. Alright, lastly, I would suggest you to ask 4 of these questions before you buy a stock. Question 1. What is my timeline on holding this stock? Question 2. How does this play into my overall investment portfolio? Question 3. How much volatility am I comfortable with? And question 4. How much can I or do I really want to invest in growth stocks? Once you have answered to all these questions, I would suggest to start investing right away. Alright, to summarize all of what I've said, growth stocks offer a chance for people to invest in individual stocks and run out their portfolios. They can offer a chance at a very profitable stock sale. However, keep in mind that most of them don't pay dividends, and there's always the risk that you'll buy into a stock that you can't sell for more than what you have bought it for, meaning that you never will really be making money out of those growth stock. Alright, so on this note, I would conclude this video. Thank you guys for watching this video. If this video has helped you understand about growth stock, please make sure to hit that like button and subscribe to this channel if you haven't already, and leave a comment. That would really help me understand your strategy and what you are thinking about investing overall. So thank you guys for watching this video. I hope you guys have liked this video, and I'll see you in my next video. Till then, take care of yourself and people around you. Goodbye.